Value at risk. VAR for a given confidence level occurs at the cutoff point that separates the tail losses from the remaining distribution. What is historical simulation approach? Order return observations and find the observation that corresponds to the VAR loss level. What is parametric estimation approach? Assumes the distribution for the underlying observations. In case of normal distribution assumptions, var is equals to minus mu r plus sigma into z, and log normal distribution assumption is var, where var equals to 1 minus e raised to power mu r minus sigma z. What is expected shortfall? It provides an estimate of tail loss by averaging the vars for increasing confidence level in the tail. Let's find out weighted historical simulation. There are many approaches. Age weighted historical simulation, it adjusts the most recent distant observation to be more heavily weighted. Okay, once more. Age weighted historical simulation adjusts the most recent observations to be more heavily weighted and less or distant observation to be less heavily weighted. What is volatility weighted historical simulation? It replaces the historical returns with volatility adjusted returns. Actual procedure for estimating VAR is unchanged. It's the same. Just the volatility is weighted average. Correlation weighted historical simulation, it updates the variance covariance matrix between assets in the portfolio. And there is one more, filtered historical simulation. It relies on bootstrapping of standardized returns based on volatility forecasts. It is able to capture conditional volatility, volatility clustering, and data asymmetry. Now, what is peak over threshold, POT? It is an application of extreme value theory to the distribution of excess losses over high threshold. The POT approach can be used to compute VAR. From estimates of VAR, we can derive the expected shortfall. What is backtesting VAR? It compares the number of instances when losses exceed the VAR level, which is exceptions, with the number predicted by the model at the chosen level of confidence. What is failure rate? The number of exceptions per number of observations. The Basel Committee requires backtesting at 99% confidence level over 1 year, establishes zones for the number of exceptions with corresponding penalties. It increases in the capital multiplier. What is mapping? Mapping involves finding common risk factors among positions in a given portfolio. It may be difficult and time consuming to manage the risk of each individual position. One can evaluate the value of portfolio positions by mapping them onto common risk factors. What is mean reversion? Implies that over time the variables or returns regress back to the mean or average return. Mean reversion rate A is expressed as st minus 1 equals to A into whole bracket mu minus st minus 1. The beta coefficient of the regression is equals to the negative of the mean reversion rate. What is autocorrelation? Measures the degree that a variable's current value is correlated to its past values. It has exact opposite properties of mean reversion. The sum of mean reversion rate and one period autocorrelation rate will always equals 1. What is correlation swap? Used to trade fixed correlation between two or more assets with a realized correlation. Realized correlation for a portfolio of n assets is P realized equals to 2 upon n square minus n summation of correlation ij, where I is greater than j. The payoff for correlation swap buyer is notional amount into correlation realized minus correlation fixed. What is Gaussian copula? It indirectly defines the correlation relationship between two variables. It maps the marginal distribution of each variable to standard normal distribution done on percentile to percentile basis. The new joint distribution is a multivariate standard normal distribution. Now, the Gaussian default time copula can be used for measuring the joint probability of default between two assets. Regression based hedge FR equals to Fn into dv01n upon dv01r into beta, where FR is face amount of hedging instrument and Fn is face amount of initial position. Bond valuation using binomial tree. Using backward induction, the value of the bond at a given node in a binomial tree is the average of present values of two possible values from the next period. The appropriate discount rate is the forward rate associated with the node under analysis. There are three basic steps to valuing an option on a fixed income instrument using a binomial tree. Step 1. Price the bond value at each node using the projected interest rates. Step 2. Calculate the intrinsic value of the derivative at each node at maturity. Step 3. Calculate the expected discounted value of derivative at each node using the risk neutral probabilities and work backward through the tree. Interest rate expectations. Expectations play an important role in determining the shape of the yield curve and can be illustrated by examining yield curves that are flat, upward sloping and downward sloping. If expected 1 year spot rate for the next 3 years are R1, R2, R3, then the 2 year and 3 year spot rates are computed as follows. R2 for 2 year spot rate for 2 year is under root of 1 plus R1, 1 plus R2 minus 1, and R3 for 3 years is 1 plus R1, 1 plus R2, 1 plus R3 का cube root minus 1. Convexity effect. All else held equal, the value of convexity increases with maturity and volatility both. Term structure models. There are multiple models. Model number 1 assumes no drift and that interest rates are normally distributed. dr is equals to sigma dw. Model 2, it adds a positive drift term to model 1 that can be interpreted as a positive risk premium associated with longer time horizons. dr equals to lambda dt plus sigma dw, where lambda is the interest rate drift. Holy model, it generates drift to incorporate time dependency. dr is equals to lambda t dt plus sigma dw. Vesicek model, it assumes a mean reverting process for the short term interest rates. dr equals to k into theta minus r into dt plus sigma dw, where k is a parameter that measures the speed of reversion adjustments and theta is a long run value of the short term rate assuming risk neutrality, and r is the current interest rate level. Model 3, it assigns a specific parameterization of time dependent volatility. dr equals to lambda t dt plus sigma e raised to minus alpha t dw, where sigma equals to volatility at t equals to 0, which decreases exponentially to 0 for alpha is greater than 0. Cox-Ingersoll-Ross model, CIR model. The mean reverting model with constant volatility sigma and the basis point volatility sigma under root r that increases with a decreasing rate. So dr equals to k into sigma minus r dt plus sigma under root of r dw. Model 4 is a log normal model. Yield volatility sigma is a constant, but basis point volatility sigma r increases with the level of short-term rate. There are two log normal models of importance: log normal with deterministic drift and log normal with mean reversion. Now put call parity is P plus S equals to C plus X into e raised to minus RT. Volatility smiles. Currency options. Implied volatility is lower for at the money options than it is for away from the money options, that is in the money and out of the money options. If the implied volatilities for actual currency options are greater for away from the money options than at the money options, the currency traders must think that there is a greater chance of extreme price movements than predicted by the log normal distribution. Volatility smile for equity options. Higher implied volatility for low strike price options. Volatility smirk, that is half a smile, exhibited by volatility options translates into a left skewed implied distribution of equity prices. Equity price changes. This indicates that the traders believe the probability of large down movements in price is greater than large up movements in price as compared with a log normal distribution. Thank you.